In the early 90s, this legendary investor financed the tiny precious metal stock at 78 cents. It then proceeded to run to $48 a share. In the early 2000s, he started a fund for uranium stocks with $15 million. This fund went to $500 million. Today, this investor, along with some of the biggest power players in the resource market, are investing in one tiny gold stock. With 4 million ounces owned through acquisition and a majority stake in a uranium play with $1 billion giant, this small stock is being aggressively accumulated by insiders, who include names like our legendary investor, Rick Rule of Sprott Asset Management, Doug Casey of Casey Research, and Mario Gennaro, dubbed the most influential man in Brazil, where this 70-cent a share company has its flagship project. It's time to back your portfolio with hard assets and partner with the right people for success. Learn more at futuremoneytrends.com/goldstock. Greetings and thank you for joining us at futuremoneytrends.com. I'm here with Jordan Royburn, author of The Coming Renewal of Gold's Secular Bull Market. He is the editor of thedailygold.com, where you can also subscribe to the Daily Gold Premium, a publication which emphasizes market timing and stock selection for the sophisticated investor. Now, I was privileged enough to get a copy of his book before this interview. I read through it. It's a great read, a smooth read. It's not like reading the history of gold. We don't go into 3000 BC. It gives you good content, relevant. It really specifically analyzes the last 100 years with gold. I think it's a must for every gold owner or anybody looking to invest in gold. It's a must read. Jordan, thank you so much for your time today.
Dan, thanks for having me on, and thank you for the kind words about my book.
Hey, I really enjoyed that book. I've been doing a lot of research for gold documentaries and different things for mining companies, and I found myself on several pages going, dang, I don't think anyone's ever put that together. So I wanted to start off with the real yield chart versus the CRB. I thought it was stunning, the information you provided, because even in the 1970s, where it's often cited by gold analysts and gold bugs like myself, was when gold rose with interest rates. This chart and data clearly shows that your thesis is correct, that whether it's commodities or gold, even in that 1976 period when there was a big spike in interest rates, we did see gold decline. So my question is, with rates near zero or in negative territory in some countries right now today, how does gold reverse the course that it's been on for the last 4 years in an already real low yield environment where yields are effectively negative versus inflation?
Well, the reason, it can reverse and go higher, you mentioned it at the beginning of your question. And in my opinion, which I talk about at the beginning of the book, is gold and also hard assets, commodities as a whole, the single major driving force is really real interest rates or real yields. And I have a couple of charts in there, one that just looks at the Fed funds rate, the Fed funds rate minus inflation. So what's the real Fed funds rate? And then also, I believe I have a 5-year real yield chart. So that is basically what is the 5-year yield on that security minus inflation. And so when these things are negative or declining, then you're not earning a real return on these assets. And that's when gold really flourishes, and also hard assets. One comment about hard assets, people always talk about, people in China, they're, the funniest thing is agriculture. When people say, they're eating a lot more meat or whatever. It's so funny to me because it's like, well, commodities were in a bear market in the 90s. I don't think the Chinese, weren't eating at that time. So it's really, it really comes back to the monetary situation and what real yields and real rates are. And so it's really interesting, as you say, because we're basically in a zero rate world. And so why gold should perform well, or I could say could perform well, is, let's simply just look at the real Fed funds rate. What's happened in the last 3 or 4 years is the real Fed funds rate was, in 2011, it was around minus 4%, I think. And what's happened is that's come back to zero because the rate of inflation has come down. So that in that time, gold has become less attractive of an asset in the U.S. because you went from losing 3 or 4% on your money to now you don't lose any money. Um, if you have your money in the bank. Now, the interesting thing is, let's look at Europe and Japan. Now, gold against foreign currencies, which is something I talk about very often. We're basically looking at gold against the inverse of the US dollar basket. So when you're looking at gold against foreign currencies, it's like, gold against 2/3 euro, gold against 20% yen, or whatever it is. But anyway, if you look at the gold price in those countries, it's bottomed and it's been going up. It looks like it's back in a new bull market. The reason for that is, well, the rates and yields in those places have gone negative. And so, before they were slightly positive or 1% or whatever, they've turned negative. I mean, I don't know what they're at today, but because of that, that makes gold a much more attractive asset in those places. And that's why the gold price in those places is much stronger than it is in the U.S. So now to come back to your question, the direct answer to that is, let's say the Fed, we're at zero rates and zero inflation right now. Let's say the Fed raises rates to 1% or 1.5% in the next 2 years. Well, if the rate of inflation goes up to 2, 3, or 4%, gold is going to do really well because we're moving from a situation where the real return is zero. And in the next year or two, in that scenario, the real return would be negative. It'd be -1 or -2%. So essentially, what gold needs inflation to go up faster than the Fed raises rates, or faster than the yields going up on the 2-year or the 5-year bond. Now, the other scenario is how it can also do well is if rates go down faster than inflation goes down. I mean, we kind of saw that in 2008, even after gold had the big correction, even though rates plunged and were going down, the Fed lowered rates to zero and did all the stimulus and QE, and so at the time, even in that scenario, real rates went from being somewhat positive to negative, and so that's how gold can do well in an inflationary or deflationary situation. We have to focus on real rates and real yields because, judging from 100 years of history, that is the strongest indicator for gold, and also secondarily commodities.
Yeah, were you surprised how strong that indicator was? Because obviously I have factored that in, and other analysts have factored that in. But after reading your book, I realized, I'm like, that man, if I had to pick one thing, this is it.
Yeah, I mean, it really is surprising how, no indicator is perfect or foolproof or whatever. But looking at this, it really makes a lot of sense on so many levels because, Dan, I mean, let's say inflation was 5%. Well, if interest rates are 10%, yeah, there's inflation, but you're earning a real return on your money. And so, because if you're in the U.S. and you're earning plus 5% real return on your money in that situation, it makes sense. You don't have any need for alternative currencies like gold or silver. And the other thing I should mention is, as to why we're still in a secular bull market. I mean, this is so interesting. If you go back and you look at 1980 and then you look at 1951 and 1920, and those were the times when commodities peaked. So I'm kind of using them as a gold proxy because the gold price was basically fixed. But when the secular trend ended, you saw a huge surge in real yields and real rates. I mean, a massive, you look at 1980, I'm looking at the real Fed funds rate. Around that time, it went from -5 up to nearly 10 in the plus 10% in the early 80s. And then you can go back to the late 1940s. Even in, I think, 1947 or 1948, real rates were at one point, they almost went to -20%. And then in the early 50s, when the bull market ended, they went from like -7 to like +1 or 2% the first couple of years. And then you go back to 1920. I mean, that was a massive swing. They went very quickly from over -15 then to +20% after that, or during that depression we had. So in the last couple of years, you didn't see that kind of increase. I mean, it's only the real Fed funds rate has only gone from -4 to basically zero. And the reason it went to zero is because oil collapsed. I mean, before oil collapsed last year, we were around -1 or -2% as far as real rates. So you haven't seen the type of increase that really typifies the end of this secular trend. And that will only happen in the future when the Fed decides we need to raise interest rates and we need positive real rates. But as I talk about later in the book, I mean, given the debt situation, the government debt situation in the U.S., Europe, all around the world, nobody can afford positive real rates for a long time. I mean, I don't see that happening for another 5+ years. So that to me is really why we're still in a secular bull market for gold and commodities. I mean, it's not going to end until there's a major change in policy where they really want to get real rates to a positive level after inflation. And as I just said, because of the debt situation, I mean, they just can't do that. I mean, if you look at the 1940s in those charts, that real rates were the most negative in the 1940s, and even though the depression was in the 1930s. But if you look at the stock market, it bottomed in 1942, and had a huge move after that. Real rates were still negative for the majority of the 1940s and sharply negative. Why was that the case? Well, they needed to have real rates negative because that's how you get inflation and that's how you kind of get out of the debt burden. We had a huge debt burden at that time. So, I mean, I think we're going to see kind of a repeat of that policy in the years ahead, and we're just in a temporary situation where inflation has plunged and the real rates and the real yields have just moved to a less favorable situation in the last couple of years for gold and hard assets. And also, gold went up a lot for 10 to 11 years. I mean, if you look at a long-term chart, it really went up in a straight line. So it needed to have a pretty long correction or a big bear market that we're kind of having.
Now, U.S. stocks also do well in a low interest rate environment, and we've seen some incredible gains with some unprecedented actions by the Fed and other central banks to support this bull market in the stock market. Would you, at this time, bet against this support and rally going forward, or would you just advise people to proceed with caution when it comes to U.S. stocks?
I would proceed with caution, basically. I mean, what I don't, in the chapter of the book where I talk about U.S. stocks, I mean, I'm not trying to give some view that we're going to have this huge 70% crash and, everything's going to fall apart. I don't see that happening. I do think in real terms, U.S. stocks are going to perform very poorly in the years ahead. But Dan, if you just look at all these valuation charts, I mean, U.S. stocks they're going from this point, they're likely going to deliver poor returns over the next 5 or 10 years. And anyone who's been so lucky to be in the market for 5+ years and they have these huge gains, I would really proceed with caution because I just don't, given, I mean, if you look at long-term valuation charts, which I have in the book, many of these valuations are at the highest levels ever, excluding 99 to 2000, which was one of the biggest bubbles of all time. So, I don't know if the market's going to crash or just perform poorly and just, maybe it'll decline 25% and then have a rally for a year or two and then have another bear market. I don't know how it's going to turn out, but if you look at the valuations, it's just almost impossible that the U.S. stock market from these levels is going to deliver better or even positive returns in the next 3 to 5 years. I mean, all these research organizations, I mean, like GMO, Jeremy Grantham's company, you look at Research Affiliates, Rob Arnott's company. I mean, they've come out with this data and what 10-year projected or expected returns are going to be. And for U.S. stocks, they're basically nothing from this point forward. And even a couple of years ago, I think these charts were saying, maybe 2 or 3%. Well, after another good 2 years, the expected return in the next 10 years is basically zero. So that's just, and there's really no, I mean, if you have to be in stocks, there's no need to be in the U.S. You can look at other emerging markets. I mean, emerging markets as a whole are trading at much cheaper valuations than U.S. stocks, and some of these countries are going to grow faster, obviously.
Hmm.
And in addition to that, emerging markets, they'll benefit. I mean, obviously, some emerging markets get hurt by inflation, some benefit. So, but on the whole, they do slightly benefit typically in an inflationary situation. So, the emerging markets that benefit from commodities being in a bull market. I mean, Russia is one that comes to mind. Those are markets, the ones that are very cheap and can benefit from commodities. I mean, those are ones that you could definitely seriously consider owning instead of U.S. stocks, which are just very overvalued and are going to deliver poor long-term returns from this point forward.
Yeah, one of the things that affects those stocks obviously is the U.S. dollar when you're buying foreign equities, and the dollar is up good 20% in the last year and a half, 2 years. Gold is also up, not by much, but despite the dollar rallying against other currencies, gold continues to hold up against the dollar since making its low in November 2013. And I wanted to ask you, what is this telling gold investors? I was kind of thinking, and I've been thinking this for 6 months, so maybe it's starting to become the wrong idea. But I was looking at it as almost the dollar topping and gold bottoming, and perhaps the reason gold wasn't losing ground to the dollar, especially in the last 6 months, and the dollar wasn't gaining against gold, was that they were just simply crossing each other, where gold was about to start making its upward climb and the dollar was about to fall. But the dollar, despite that, I mean, is sitting here making, I think, a new high against the yen this morning. So what is your overall thought on this situation where the gold has definitely stopped going down against the dollar, but the dollar has not stopped its rally against all other currencies?
Yeah, I mean that's an excellent question. I was thinking the same thing. It's really disappointing to me because I was thinking that late last year when gold was showing tremendous relative strength, I was thinking, okay, that's great. You know, gold got up to 1,300. Once the dollar starts going down, gold can break out of this bottoming pattern and get to 1,400 maybe. So we didn't see that. I mean, I'm surprised how how the relative strength that gold was showing initially, and then when the dollar was falling, gold barely did anything. But you know, a couple of things on the gold dollar relationship, as I mentioned in the book. I mean, typically, if you just go back since 1976, gold will often bottom maybe 4 to 5 months before the dollar peaks. So that's one thing to keep in mind. But you know, I sent you a chart which I might include in a new version of the book. I mean, it's looking at I like to look at all the bull and bear markets of gold and silver, and put these on one chart. But we have three major bull markets in the dollar: 92 to 2001, and then the one before that, which I think was 78 to 85, and then the one we have now, which is the third one. And looking at that chart, and also the fact that gold didn't do much when the dollar was falling, that just tells me I think we're going to see another leg higher in the dollar and unfortunately another leg lower in gold. Maybe, I mean, I think if we do get another leg lower, it's really going to be the final capitulation, and then we're going to see the end of the bear market. I'm actually hoping that happens because over the last 2 years, it's been really difficult. All these big moves in gold going back and forth, and it looks like it's going to finally break down, and then it doesn't, and then it starts going up again, and then when it looks really good technically, then it immediately turns down again, and it's been so frustrating that I think if we could have a real final breakdown, I think that would be bullish. Obviously, not when it breaks down immediately, but after that point. So I think um, gold has shown really good relative strength against the dollar, and that's also reflected in the gold against foreign currencies chart, which I think that had like a 20% gain from, I want to say, the end of last year into January when it peaked. And that definitely got really overheated. And so I think a problem which we could have in the next month or two is gold could be weak against foreign currencies, but also in US dollars at the same time. And that could kind of push it down to perhaps a new and final low. Um, look, going forward, if the dollar makes a new high, I mean, Obviously, I think it would be negative for precious metals, but keep in mind, as I said, precious metals tend to bottom before the dollar peaks. I'm seeing a lot of similarities to the bottom that we had in 2000, 2001. If you look at gold against foreign currencies, that bottomed, I think, by like more than a year
Hmm.
before gold did. So gold and foreign currencies were the first to bottom. Then gold stocks bottomed, I think, like 8 months before the U.S. dollar topped, and then gold in early 2001 was about 4 months before the U.S. dollar topped. So I wouldn't be surprised if we see a similar situation where the US dollar keeps moving up. It's negative in the next couple of months for precious metals, but then precious metals find a bottom. They start rallying even a couple months before the dollar peaks. I think that's, as we get into the summer, that's a situation that could play out. So I think in the very short term here in the next month or two, I think unfortunately dollar strength will be bullish for precious metals. And it really could just be a final capitulation where, because we are starting to see inflation expectations increase a little bit. Um, so unfortunately, it could just be a situation in the next couple months where the dollar starts to rise. And because gold couldn't get a lot of traction recently, we just see people panicking out. And that kind of causes the final bottom, perhaps.
How about for the mining stocks? In your book, you point out that this could be a major bottom in 2015. I mean, looking at the dates you brought up, it could be a generational buy for a lot of people. And prior to this call, prior to this interview, when we jumped on a call, we had briefly spoke about the Cambridge House, which is in Vancouver, infamous for its mining shows. I believe last year they had 70, but probably the previous year to that they probably had 200. And this year, I've seen on their website that they only have about 22 junior mining companies showing up. I mean, this has got to be it, right?
Yeah, I mean, well, there's a couple of different things I want to say. I'm just deciding which I'm going to say first, but there's a lot of contrary indicate, and one thing about the contrary indicators and buy when there's blood in the streets. Sometimes it's really immediate. It happens over like a month or two, and sometimes it can take a couple years. And obviously, that's what we've seen, because if you look at gold stocks going back to 2013. I'll get into this later, but they made a valuation low when they crashed in 2013, and then at the 2014 November low. So, I mean, this is kind of a bottom that's taking several years. And we also saw that play out, I think, in 99 to 2000, 2001, that bottom. But yeah, there's a lot of contrary indicators, and that doesn't necessarily mean that there's going to be a bottom that day or that week or that month. It just, I mean, it tells you that a major bottom is coming, or it's around this time frame. I mean, that's a contrary indicator. I mean, another contrary indicator is, I mean, I won't say the company's name, but it's basically a fund manager. They have some mutual funds for resources, and they just started an airline ETF. Now, the airlines are up tenfold in the last 5 or 6 years. I remember Jim Rogers, who you interviewed. I remember in 2008 watching TV, and Jim Rogers said he bought airlines, and I was thinking, what the hell is he doing, and why is he buying airlines? Well, they've performed extremely well in the last 5 or 6 years. I mean, that was an amazing call by Jim Rogers. But look, when a resource centric fund house starts an airline ETF that's really not in, it's a completely different sector. When you're 4 years into a severe resource bear market, and after airlines have already gone up by tenfold, that to me is a huge contrary indicator. So yeah, we're just seeing so many of those. And looking at the gold stocks, I mean, Dan, it's really amazing. Looking at the valuations, I wish someone had data going back, 100 plus years, because a lot of the data that I compiled and put in the book, it goes back to 1980 or 1975. If you look at the senior gold stocks, price to cash flow going back to 1975, at the recent November low, it was the lowest that it's ever been. So the lowest in the last 40 years. If you look at gold stocks versus gold, you go back to the recent November low, that's the lowest that it's ever been going back to 1938. If you look at the price to book value for the miners, that's the lowest that it's ever been since 1980. If you look at gold stocks as far as their value versus their ounces in the ground, I have that chart in the book. That's the lowest it's been, I think, in the last 30 years. So you look at all these things are not just at 5 or 10 year lows. I mean, they're at 70-year lows, they're 30-year lows, or 50-year lows. I mean, this is really amazing how cheap this sector has become. And I remember talking to a company a couple of months ago, and I said, we're either going to have the greatest recovery, or this, or the gold mining industry is going to become extinct. I mean, there's just no other way that it's going to happen. So this is really, I mean, the bottom that we're coming to, and I think for the most part, I think it's going to be this year and the next couple of months. If I'm wrong, maybe it'll be the end of the year, or early next year. I mean, this is really going to be a historic bottom, and gold stocks are really, not just in the next couple of years, but really, I think in the next 5 or 7 years, they're really poised to perform extremely well. I mean, they're just amazingly cheap. And if you look at these bear markets, this is the second worst bear market that we've ever had in the history of gold stocks. And I mean, it looks like it's not over yet. It looks like it might have one more leg down. But it's so amazing, just the carnage in this industry, and how long this bear has gone on. And I mean, there's even some companies have actually done well in the last year, 18 months. I mean, there's many companies that have rallied way off their bottoms. I mean, most good junior, there's kind of a bifurcation, and Rick Rule talks about this. Most good, strong, top-notch junior companies, they've probably already bottomed and rallied, but a lot of the others have really struggled, and those are the ones that may not survive and may not make it. We're also seeing it with larger companies. I mean, Newmont has done really well, whereas a lot of other companies haven't rallied as much. And if you look at, I mean, the fundamentals for this industry have really improved recently, because the crash in oil is huge. I mean, for companies that have open pit mines, which are very energy intensive, oil, it can be up to 30% of the cost of mining. And then secondly, gold against foreign currencies. Now, if you're operating a mine in, let's say, Mexico or Canada, you pay a lot of your costs in those local currencies, and the price of gold in those local currencies is very strong. So there's the fundamentals for the gold stocks. I mean, they've already started to improve. I mean, the fundamentals have bottomed. The next thing is we just need to see the prices for the whole sector bottom. And it's just a situation where the metals prices have not bottomed. If you go back to that 2000, 2001 bottom, the gold stocks bottomed 4 or 5 months before gold did. They had a good rally. But you know what happened in the HUI? As soon as gold bottomed and went up for a couple months, in that 2-month period, the Huey went up 60%. So I think we could possibly see something like that, where once the metals bottom and start moving up, that could be when the gold stocks, the sector as a whole, really starts to take off. But obviously, it looks like we're not quite there yet, but we're very, very close.
Yeah, it seems to me that the investors, they have the luxury of being able to speculate on some of the highest quality names now, because you no longer need to find some unknown company to, a very speculative one where they're just starting to drill to make the big money. Now you can buy a high quality business, exploration or near-term producer, and they've all been beaten to shit. So, I don't want to mention any names on air. I know you have a paid membership area that people can get some names, but I mean, right now it's like the cream of the crop is at fire sale pricing. I want to ask you one last question, if we have about 3 more minutes here, and that's silver. It's probably every precious metal investor's favorite topic, and I kind of want to just close with what your thoughts are on silver going forward, because it does have those bigger price swings than gold. However, I mean, to me, it seems that silver's not making any new highs until gold starts moving up dramatically.
Yeah, I mean, that probably will be the case. I mean, it's interesting because I don't know, to be honest, how this bottom might play out, because maybe you could see silver bottom first, because remember, silver peaked, I think, in April 2011. Gold peaked 5 or 6 months later. So it would make sense that silver could bottom first. But when you look at the chart patterns of both, and you look at you just look at the history. I mean, we know that usually once gold gets going, it starts moving up. That's when silver then starts moving after that. Then it really catches fire and outperforms. And I think, we can probably expect that with silver. And as I talk about in the book, I mean, if you look at the technicals of silver, it's really, I think the key levels are, I'm just going back here, scrolling in my book file, but the key levels for silver are $15, $21, and $35. And that's if you look at a monthly chart. And I don't know where silver is going to bottom. I think it might have one more leg lower. But if that's the case, again, the key levels, the first one will be 15, and then 21, and then 35. And I think, coming out of these major bottoms, the metals, they obviously perform very, very well. So, I mean, I don't know how long it's going to take silver to get to 21 or 35. Obviously, nobody knows. But the fact is with silver, once it breaks 35, then 50 is really the last resistance. And then you see silver break 50, then it's really going to get going. So it's going to be a situation with silver where it's going to take some time. But as it surpasses those resistance levels, it's going to pick up an increasing amount of momentum. And then I think once it breaks 35, that's when you'll start to see it really move. And of course, then it breaks 50, and then obviously people will be really, really excited. But Dan, that's probably, who knows? That could be 3 years away. I just don't know. And the same thing with gold. I mean, when people say, oh, gold could go to 5,000 or 6,000 or 7,000, if you look at gold in the chart, the breakout above 1,900 is going to be very significant. But once, in my opinion, and looking at my work, I mean, once gold kind of gets above 3,000, that could be when it starts to go parabolic. And for silver, I don't know, it could be $50 for silver. When it breaks above that, it could have less than 2 years left, perhaps. And that could be the time where it makes a really aggressive move up. So the thing with silver is it's going to start slow, and it's going to pick up a lot of steam over time, but not initially. And so that will help some investors. They can kind of maybe wait and stay on the sidelines and wait for silver to have a monthly close above 15 or even a monthly close above 21. I mean, those are the first two key levels. So that's kind of how I see silver. It's possible that silver could bottom first, but ultimately silver probably isn't really going to get going until we see gold, I think, retesting 1,800 or 1,900. And so, I don't know when that's going to be, maybe 2 years from now, maybe a little bit sooner. But, that could be the point when silver really starts to outperform gold strongly and really picks up momentum. But again, silver, I mean, it could be a slow starter. It could take some time for that to happen. But ultimately, silver, I think, is going to be, I mean, if we do have another leg higher in the secular bull market, as both of us believe, silver will outperform gold and silver will be a massive winner, but it's going to take some time for that to happen.
Jordan Royburn of thedailygold.com. Sir, thank you so much for your time. If someone would like to buy The Coming Renewal of Gold Secular Bull Market, where is the best place for them to go?
The best place for them to go is Amazon. If they have an iPad or a Kindle, they can read it with that. Just go to Amazon and you can type in my name or type in that long title, The Renewal of Gold's Secular Bull Market. That's what they can do. I also have a free newsletter you can sign up for on my website, thedailygold.com, and I'm giving away a free chapter in the book, the first chapter with these charts on real rates and real yields. So sign up for my free newsletter and you'll get that and another free report. And also I send it out every week and I kind of send snippets, which give an example of the work I do in my premium service.
That's great. Well, hey, Jordan, thank you so much for your time. You have a great day, and I really appreciate your time. That was a must-read book for everybody.
Dan, thanks so much for having me. I really appreciate it.